I'm Charlotte McLeod with the Investing News Network, and here today with me is Jeffrey Christian, Managing Partner at CPM Group. Thanks so much for coming today.
Glad to be here, Charlotte.
Okay, and we're here at PDAC. It's the afternoon of the first day. What's your sense of the mood so far?
I really haven't been around long enough to pick it up. I mean, it looks like there's a good crowd. Mm-hmm. Most people are smiling. They're not crying into their beers yet. Yeah.
Okay, so we spoke last at the end of January. That was right after we spoke in the fall, right after Barrick Randgold, and then again after Newmont Gold Corp, and now we have a new mega merger development. Can you update me with your thoughts there?
Oh, I'm always focusing on companies that generate profits. Mm-hmm. And I think one of the problems with the large companies is they haven't been generating profits, and they've been focusing on the number of ounces that they're producing as opposed to the number of dollars of profit. And so I always tend to focus on looking for companies that have a nice cash margin. Now the Barrick Randgold deal made sense because Randgold was an improvement for Barrick's 5-year outlook. The Newmont Gold Corp deal didn't make so much sense, mm-hmm. and I think the Newmont Barrick deal doesn't make that much sense. You're getting bigger and bigger. You'll just have more and more troubles trying to maintain your production because you're so afraid that your production will go down instead of focusing on increasing your profits. I'm not sure that the deals will be particularly accretive for the shareholders of the big companies, but they'll be the merged companies will be sloughing off a lot of interesting properties that could be very profitable for smaller mining companies that buy them and for their shareholders.
Okay. Speaking about just being large companies, Mark Bristow has spoken to the value of being a large company, saying that it may attract generalist investors back to the gold space. Do we need those generalist investors? Is that a good argument?
I don't think it's a good argument. I was there with Peter Monk 19 years ago when a large institutional investor said to him, yes, you're the largest gold mining company in the world, but from our perspective, you're a microcap. And he was very offended, and he went on an acquisition spree as a result. And I think he should have focused on generating profits instead of that. One of the things that if you look at the history of gold mining, mm-hmm. not just the last 100 years, but the last 300 years, there's always been ample capital for smaller profitable companies. And you don't have to chase those big institutions. And quite frankly, given the nature of the gold mining industry, it's very frustrating to try to chase them because you're so small relative to the overall capitalization and their assets under management. So it really doesn't make sense to try to go for those guys. It really makes sense to focus on your profitability, mm-hmm. and you will get as much capital as you need to run a smaller but more profitable company.
Right. One question that comes up a lot in our audience is there money available for the smaller companies? And would you argue that if they're a good company, they will get the money they need?
There is plenty of money that's interested in investing in gold mining companies and general mining companies. They've been frustrated by the lack of profitability and performance, both with the smaller companies and the exploration plays, as well as the larger companies. So there's a lot of introspection right now among institutional investors, and we work with institutional investors in China, around the world, China, North America, Europe, South Africa, really around the world. And a lot of these institutions are stopping and trying to consider how they want to invest in mining, but they've had such a dismal success in finding well-managed and profitable mining companies that they're really sort of at their loss right now as to how to do it. So there's a lot of work that we're talking to mm-hmm. institutions about, like how do you effectively find attractive, successful, profitable mining companies.
What would some of your advice be on that point?
Well, we get approached by large institutions that are saying, we want to put 200 million or 400 million into gold mining companies. What should we invest in? And our comment to them is, there's no company that can absorb 200 or 400 million of your capital that you'll be happy investing in. What you really do, if you have $200 million that you want to invest in profitable and attractive gold mining companies, you probably have to think about putting $20 to $40 million into 5 or 10 companies and do that. And then you have to do all the homework, because you have to look at the management first, and then there's a host of other issues as to whether or not those companies make good investments. So it's a lot of hard work to find and build a portfolio of attractive mining companies.
And for investors, I imagine it would be the same, a lot of hard work. Would they also be dividing between many companies in a similar way, or do you recommend a different approach for investors?
I recommend looking at individual companies. There's some evidence that index investing and ETF investing and basket investing can outperform individual stock picking on an ongoing basis, but I think that's not necessarily true in every industry, and I think that given the overall performance that we've seen over the last 10 years in the mining industry, it's probably not true there. So I really think that investors have to stop being lazy, and they have to sit up straight and do their homework and really spend a lot of time studying the companies. And also, they have to be very careful about where they're getting their advice and information, because there's so many people who are marketing agents, not analysts or or buy-side investing consultants, that will tell you what to invest in because they have a vested interest in you investing in that particular company.
When you're looking at one of these companies, what are the documents you're going through? What are the most important ones investors should be keeping an eye on?
I think everything is important, and we're data hogs. We're very much data hogs. The first thing that we look at, and the first criteria that we screen for, is management. And the second one is their expectations moving forward. And then the third one is how they've measured up their performance over the last, say, 5 or 10 years to what their expectations were 5 or 10 years ago. Okay. And then you have country risk, you have operational risk, you have metallurgical risk. There's just an enormous range of information that someone ought to study, and it's available in 10Qs and 10Ks and the Canadian equivalents, but you have to do your homework.
Okay, so let's talk about the gold price. You've said previously you don't see a big increase this year, but you've also emphasized the value of doing short-term trades. Can you see right now places during the year, seasonal times, when you would make short-term trades like that, or is it really an in-the-moment thing that you would be looking at?
It's really an in-the-moment thing. We're constantly looking at market metrics and volumes on the futures market and the options market, and where the options are, what the strike prices and maturities are of the options that are being invested in. We're looking at ETFs, we're looking at coin sales. There's a whole range of metrics. There's some seasonality, so yes, we tend to be bullish in December and January. We tend to start turning bearish in March and April because of those seasonal factors. But those seasonal factors easily get overridden by specific industry events or economic events. So we're also paying attention to that stuff. So there's no real easy answer, like sell in May and go away makes sense.
Sure.
And more often than not, it's right, but sometimes it's wrong.
Okay, so perhaps this year not an exciting year for gold, but I know you believe in gold's potential to rise very high in the longer term. Can you just briefly go over what makes you feel positive about gold in the future? Yeah,
I think there are two broad sets. First off, there's the economic and financial and political environment, which heavily influences investment demand. And our view is that the economy is actually in pretty good shape this year. We are worried about a shallow recession maybe next year, but we're much more worried about a deeper recession that could have severe financial constraints on a global basis 5 to 7 years from now. And so that's why we're saying we think the price could rise sharply then. And there are political and economic and financial market factors that support that view of the macroeconomic environment. But then on the other side, the other set of factors are the gold market fundamentals. The gold market is very tight, believe it or not, we saw last year, as we talked in January, lower demand for gold in 2018 than in any year, physical gold, than in any year since 2000. And that reflected that economic environment, which told investors this is not the time to be long gold. As we go forward and the economic environment brings investors back into the market, the gold market's going to be very tight. And it's going to require higher prices to induce central banks to buy less gold, to induce other people to sell jewelry for scrap, to be refined into gold, and to induce other investors to sell into the gold market to meet rising investment demand. So the gold market is basically tight and relatively illiquid. So when we see those economic factors rekindling investor interest in gold as a safe haven and a portfolio diversifier, we think it will have a dramatic effect on the price.
Do you have any specific price predictions, for example, for this year or in the future?
Yeah, we're looking at like 380, 400 by the end of this year, and we're looking at like 450 to 1500, 1450. I'm sorry, yeah, 1380 to 1400 by the end of this year, and 1450 to 1500, say by the end of next year. And that's the end of 2020. It's a presidential election year. We'll be 2 years into whatever follows the Brexit failure this month, and we'll be 2 years further down the road economically, financially, and politically. So I think at that point you could see investors interested in a lot more gold.
Okay, as we finish up, are there any trends in the resource sector that you think investors may be overlooking? There's a lot of talk right now about M&A. What are we not seeing?
Well, I think the M&A issue is a big one for the equities market, and
Sure.
we're primarily commodities people. I think that one of the things that is probably most underappreciated is the inherent strength that still exists in the U.S. economy this year.
Okay.
Yeah, we have high employment, and yes, very low unemployment, and you're starting to see some inflationary pressures, but the inflationary pressures are very modest, and there's a tremendous amount of space still for the U.S. economy to expand. I think one of the things we've seen over the last 2 months, or the first 2 months of this year, is an increased bearishness toward the U.S. economic prospects. And I think that dissipates over the next 2 to 4 months, and that then would be reflected in somewhat lower gold prices.
Okay, well, thank you so much. I think we'll leave it there for now. It's great to talk to you again.
It's always a pleasure.
Thank you. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Jeffrey Christian.